I think the economy, though, is the worry, at least for the time being. And there are just signs that the economy is gently weakening. It's not collapsing by any stretch of the imagination, but we're just starting to see more and more data, whether it's consumer oriented, business oriented, that's weakening. And if we are going to a recession, it's going to be very hard for corporate earnings to try to live up to the pretty lofty targets.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week for another weekly market recap this week, featuring my good friend, the portfolio manager, Michael Lebowitz. Michael, how you doing?
I'm doing great, Adam. How are you?
I'm doing wonderful. It's July 3rd as we're recording this. I think this will launch on July 5th. So everybody watching, yourself included, Michael, I'm going to wish you a happy 4th of July. Hope you have a great, hope you had a great Independence Day if you're watching this on the day this video actually releases. But Michael, I hope you have a good one tomorrow.
Thank you. It's nice that it falls on a Friday as opposed to the middle of the week like normal.
It is nice. And folks, we're recording this on Thursday because the markets are not open on Friday. And I also want Michael to be able to enjoy his 4th of July without having to have any recording duties. Obviously, Lance Roberts is not here this week. He is traveling in the UK, I believe. I think he's actually hopefully going to be having a meal at the Clarkson pub, maybe going to tour the Clarkson farm, and going to come back with a whole bunch of war stories for us, I'm sure.
Right. Right. I haven't, you know what? He's actually been on vacation. I have not heard from him, which is a first for Lance being on vacation. So kudos to Lance.
Really, kudos to Lance. I might have to just call him then, just to just not let him get off scot-free.
There you go.
All right. Well, look, as usual, Lance leaves and interesting things happen. So we'll talk in just a moment about the surprise jobs report that just came out, Michael. But why don't we just start with the markets themselves? Can we take a look at the technicals of the market, because it does seem that the bulls are now fully in charge, almost to the point, Michael, where is there a melt up that might be going in process here?
Um, yes. Melt up is a good word. So it was wasn't the most volatile week, but year end or quarter end, apologize, created a little bit of volatility. What we saw was that some of those momentum stocks that were leading the way, the Palantirs of the world, the Nvidias, they got hit hard on July the 1st after running up for the better part of the first quarter. And a lot of that just has to do with institutional investors wanting to sell, relieve some of their holdings once you get past quarter end, so that at quarter end they could show their investors, look, I owned Palantir and Nvidia, but they were de-risking on July 1st. That's typical at quarter ends and even more so at year end. So part of the chore an investor had to do this week was try to ignore what happens on the last few days and the first couple days of around the quarter end. And the market's behaving more normal today. So hopefully the quarter end impact is beyond us now. But what I have up is a graph of the S&P 500, and there's a few notable things on the graph. First of all, we're at all-time highs, and the market's up another 50 or so to close the week before the holiday. So again, another high, and it's been a very consistent pattern upward for the last 2 weeks. If you look up at the top, you see the moving average convergence divergence for the MACD. And that kind of consistent bullish trend has persisted ever since that those two crossed back into bullish territory. What's interesting, though, is that you can see they crossed for the first time in mid-May, potential bearish signal, but it never materialized into a relieving of the overboughtness. The two moving average lines just kind of crisscrossed each other in a relatively unusual fashion. So we got back here and the lines are diverging again, meaning that we have a bullish trend taking place. The bottom line is also the RSI. That's at a decently overbought level. So one issue we have with the recent rally is that it's occurring or it's starting from very overbought levels. So we want to temper, at least for the next week or so, enthusiasm that because we're at new highs, we're just going to go hitting new highs for the rest of the year. We're due for some sort of consolidation, maybe a respite, maybe a decline of some sort before we could get this going. Now, if you're looking for levels to potentially act as support, the first level would just be the old high, which is roughly 6140, which is that resistance line. So even that, even if we just go back down to that, that's 130 points, 2% or so, 2.5%. And then we can really start looking at the old support line and those moving averages. Now, the moving averages are confirming that we're back in a bullish trend. You can see the 50-day moving average is above the 100 and 200 again. It's sloping nicely upwards. You could see that the 200-day continues to slope upwards. It never really turned downwards. And the 100-day in blue is just starting to resume its upward track as well. So those three lines, starting with the 50, then the 100, then the 200, should provide resistance if we break that back down into the upper 5,000s. So those are some levels to watch out for. On the upper side, it's more difficult because we're at all-time highs. So there are no prior prices that can act as resistance to this rally. That said, both the RSI and MACD are at pretty high levels and overbought. So I would expect at a minimum consolidation and possibly a few percent downside. Obviously, there's news coming out over the next month or two that could impact that. But from a purely technical perspective, that's what I would keep an eye on. The next graph shows us why we got to be careful not to get too bearish over what may occur over the next week or two. July tends to be one of the best months in history outside of November. And I just got this graph from Carson here, and it shows that over various time periods, including post-election years, July is a very good month. It's very beneficial for stocks. So, we have that seasonal effect. Again, it doesn't mean that all Julys are good. There have been bad Julys, but this July is shaping up to be decent, especially probably the latter half. So what's in the latter half? Of note will be earnings and the Fed. The Fed meets in about 3 weeks or so, 4 weeks actually, and starting around mid-month, we'll start getting all the earnings. And the earnings could be interesting because they're going to start talking about tariffs and they're going to start talking about the impact of the consumer. We know consumption has slowed down. GDP has slowed down. PCE spending has slowed down. Incomes have slowed. How did that affect companies? Regarding the tariffs, how much of the tariffs did they eat? How much did the companies selling them the product eat? And how much are they pushing on to consumers? And we'll see that in their margins and in their forward-looking statements. And of course, the tariffs are still very much unsolved. So there'll be a lot of discussion from, I suspect, many companies about the tariffs and the impact that they can have and what they're looking for and providing guidance or not providing guidance. So, there's a potential for fireworks from some of these earnings reports. Could be good fireworks or bad fireworks. We'll take it as it comes. And then I think the one other thing in June that's becomes pretty important is the CPI and PPI reports. So far, both have been below expectations and running really low, about 0.1 on average for the last 4 months or so. That's a running rate that's below the Fed's target. The market has largely dismissed it because it's looking for tariff impacted inflation, which we don't think that impulse will be particularly strong, but we won't know until we get this report. This is really the first report that should fully incorporate a lot of those tariffs and the price changes that were impacted from those tariffs. So the June CPI report that will come out in July should be very helpful for to see, is there an impact from the tariffs? Some Fed members are backing away quickly from that thought. Others are kind of sticking with it. We know that some of the surveys are backing off from it, but until we get data for June, July, August, even September, we're not going to really know. And that too has the potential to help the bond market and the stock market, or to hinder both of them. So, I think July could be an interesting month and help guide us for the rest of the year.
Okay. Do me a favor, Michael, go back to the chart of the S&P there. So, all right, we've had this real big breakout, right, since the bull flag there in mid-June. And look, they say that a bull market climbs a wall of worry, right? And from the April lows, right, when everybody was probably at peak worry this year, there were concerns about just the disruptiveness of the new Trump administration's policies. And then Trump came out on Liberation Day with that big poster board, freaked everybody out because nobody was expecting the numbers that were on there. And the market has climbed the wall of worry, right?
Well,
It's
is
the
it really a
question.
wall of worry?
Pardon me?
Is it really a wall of worry? What are we really worried about?
Well, we were worried about back then. We were worried about the price inflationary potential price inflationary impact of these tariffs,
Mhm.
which were now much higher than people thought. People were worried that we were pushing all of our allies away from us and kind of breaking world trade. Things were heating up in the Middle East, and not that long ago, people were worried about World War III. I mean, there's just been a lot of things that were unknowns, a lot of uncertainty. Uh, a lot of really worrisome headlines. If you remember, recession was coming back into the headlines back in March and April. Um, it seems like a lot of that is bled out now and has been largely resolved, or is looking like it's on its way to resolution. So I'm just curious, like, if we're running out of worry, if we have this big, breakout now, is there a concern we're running out of worry for the bull market to keep climbing?
There's always worries. So if your theory is that the market needs to climb a wall of worry, there's always something to worry about. It's like having kids. You're always worrying about something. The market's very similar. Even, my kids are all out of the house and older. I still worry about them all the time. Uh, the market is very similar. There's always something to worry about. I think what the market has done is it got presented a lot of worries at the same time, a lot of substantial worries, and it came to grips with them. And look, the administration helped. It backed off on a lot of the tariffs. The Israel-Iran war turned out to be much less than some of us feared. The impact on the price of oil was minimal. So it came to grips with those worries. But I think as we look ahead, there are going to be new worries. Some of those worries, we don't know what they're going to be. There's still a worry about tariffs, right? Things could change. I think the date is now July 9th that countries are going to get hit with tariffs. Hopefully, Trump wakes up on the right side of the bed that day. Or we could be, we're not going to get a redo of early April, but it could, harm the market for a while. I think the economy, though, is the worry, at least for the time being. And there are just signs that the economy is gently weakening. It's not collapsing by any stretch of the imagination, but we're just starting to see more and more data, whether it's consumer oriented, business oriented, that's weakening. It's not, again, not recessionary, but we're below average on a lot of data. So as we go through the summer, we'll keep watching this data. And if we are going to a recession, it's going to be very hard for corporate earnings to try to live up to the pretty lofty targets. If we stay in just this weakening, running economic growth in the 1.5% range versus 2.5 or so, that's not good for corporate earnings either, especially if companies are eating some or all of the tariffs.
Right, which it
Obviously,
seems right now they are. Yeah, will that change?
right,
Who knows?
right, and obviously company dependent. Um, so that's a worry that I think is slowly materializing, and maybe that's what we've seen in a bond market the last week or two, yields coming down a little bit. Expectations the Fed may cut a little more than it did a few weeks ago. But again, so much of the economy is based on sentiment, on business leader sentiment, on individual consumer sentiment, and sentiment can change rapidly. So, I think that's the worry that we know of. There's all the unknowns, and obviously Israel, Iran could become a big issue. Russia, Ukraine could become an issue, and there's 10 other things that could become issues that we're not even beginning to think about.
All right. Well, let me ask you this then. So, if you look back to where we were in February, right, when we were back to near all-time highs again, um, a lot of uncertainty was thrown into the mix. That's why the markets went down. They've now since recovered, and then more so. But there are tariffs. You know, tariffs aren't going to go to zero, highly likely. So there's going to be some more tariffs than there were back in February. Um, you just mentioned data that presumably the rest of Wall Street can see that show that things are weakening. So what is it that is powering the market out of this breakout channel higher like this? Is it we're seeing some better corporate earnings than some of the big players? Is it people are looking ahead and saying, hey, I think we're going to see a goose to economic growth coming from all this new administration's policies? I'm sure that's what the administration would like to think. Do we have a sense of why, fast forward from February to today, we kind of have more weight on the economy, and yet stocks have decided this is a great time to break out to the upside?
So I'm asking an honest question here. What's the opposite of the word worry? I'm trying to come up with the word for it and I can't.
Exuberance, confidence,
Yeah, it's not exuberance, but just confidence or
hubris?
hubris. So, yes, you have things to worry about, but what about the build out of AI? It's massive. The money going into these data centers and powering the data centers and the benefits from AI and all the computer build out and chip build out and all that. So you also have to balance out we'll call it hubris and the worry. And there's a lot to be optimistic about as well. That maybe AI is the thing that can break us from this 40-year productivity growth slump. And if that's the case, stocks can become pretty cheap if productivity growth is really going to start accelerating from here, because it's been in a downslide for 40 plus years. So, there's arguments on both sides and ebbs and flows. And, the other hard part with this is you're looking at the S&P 500. So you're really looking at the performance of 10 stocks
That's what I was going to
that are
ask.
driving.
Is this really just those big AI companies just driving the average higher here?
It's certainly pushing it higher. Not all of the Magnificent Seven are rising. We've had the biggest divergence this year compared to the last 2 years. Three or
Right.
four of the stocks are down. Tesla, Apple are down. Microsoft, Nvidia are leading the Magnificent Seven. So we've had divergence. So it's not fair to just say it's those 7 or 10 companies, but it is companies involved in the AI pursuit that have been helping the market out and gently pushing it higher. Not that other stocks haven't been involved, but we've certainly seen momentum driving it. I talked about this earlier on July 1st, momentum stocks got killed, but they were the ones that were pushing the market up for the prior month or two. So, it's there's stuff to be optimistic about too. And maybe we'll get good tariff deals. Maybe at the end of the day, we end up in a place where the tariffs that we're paying are less than they were. And the tariffs that we're imposing are more than they were. So we're taking in more tax dollars via tariffs and we're paying less. So, who knows how the tariffs are going to end up, what's going to happen, but it's just as easy to paint a positive picture as a negative picture. And I think that's the key as an investor. You always have to consider every case. And if you are uber bullish or uber bearish, I highly encourage you to read the case for those with opposing views, because that's where you're either going to gain conviction or you're going to strengthen your own case, or I'm sorry, you're going to start wavering on your case. So it's important to, regardless of what your thoughts are, think about what all the other considerations are.
Okay. And I'm going to ask you in a little bit, what steps you guys are taking at RIA, given what's going on right now, because you got to not just have an opinion, you got to put literally your money where your mouth is. You might have mentioned this, but looking down at the RSI chart here, Michael,
Mhm.
we're seeing it, kind of break through this trading range that at least it stayed in for the whatever the 6+ months, 7+ months of this data set here. How notable is that to you of just saying, okay, this is looking like it's pretty overbought here in the short term?
Exactly. That and the MACD, just the level where the MACD is. That's there, even though the MACD is on a breakout, the RSI is very high. So continued run up here is not very likely, or it's just getting more and more overbought. I wouldn't call it quite extreme yet, but it's starting to get there. So again, we need a break. What does that break look like to get the RSI back down, to get the MACD back down a little bit? It can just be 2 weeks of going nowhere. It could be 2 weeks of declining 5%. But that's probably what's in store for the next week or possibly 2 weeks. Something to relieve some of that overboughtness, which then allows more pressure to let it go up to new highs once again. Kind of a stair-step pattern
Hmm.
of you're going up and the market's become more overbought. The market needs to relieve itself a little bit because everyone's on one side of the trade. It does that, and then you can take that next step higher.
Okay. So, it's interesting. Uh, the market generally likes it when it thinks the Fed is going to be cutting rates. Um,
Hmm.
and yet, you made brief mention to this a few minutes ago, but this morning we got the new non-farm payrolls, the June non-farm payrolls report, and it was substantially stronger than expected, which is something that is likely going to make it a bit harder for the Fed to cut rates. In fact, I think expectations for a July rate cut just vaporized after that non-farm payrolls report went out. But market didn't seem to care. Markets leapt higher on the news, or at least on the same day as this news. So I don't know. Maybe we should trundle into the payroll data.
Yeah, let's look at that. I'm going to go back to sharing a graph. And I came into this morning thinking the number would be weak. So expectations were for roughly 100,000 new jobs, which is weak. That compares to 200,000-ish, kind of the running average. Um, they came in strong. And there actually weren't revisions. There were positive revisions for the last 2 months. Not
I
large,
know,
but positive.
but still, we're just not used to that, right? We're used to negative revisions of all the previous month prints. So this month was
Right.
both a surprise beat, and they then raised the May and April data.
And don't get me wrong, those could then again be revised lower. And then when they go back a year or two from now, they could be revised much lower. But it was notable they were revised higher, at least this time. The reason I thought it would be a weak number is because ADP came out with minus 33,000 jobs on Wednesday. So ADP uses actual records from 400,000 businesses. It's using real data. The BLS is using surveys of corporations and individuals. to come up with its data. The business is where you get the job gains. That's what was it, 170,000, something in that vicinity. It's been a long day. That's where that number comes from. The unemployment rate is partially the result of that household survey. So there's two surveys within the BLS. The one that makes a headline is the business survey, but it's a survey. They're calling the HR and saying, "Hey, how many employees, net employees did you hire?" Oh, I don't know, we had 10. I'm sure some of them have actual records. They're looking at a spreadsheet, they see it. Others are getting this question every 2, 3 weeks. Probably had about 10 or 12.
Yeah.
Make a guess. So I think the ADP is a better predictor of the actual state of the employment market, but it doesn't matter what I think because the market, the Fed, tends to heavily rely on the BLS. So we can look at the BLS and, well, first of all, here you see are the 3-month moving averages for ADP in that, I guess you call that teal, and the BLS in the dark blue. So the BLS is running about 150,000 new jobs a month. It's a decent pace, while ADP is 18,000. So ADP is basically showing that growth has in employment has basically gone to zero. And you can see the two for the last few years, the two have followed the same direction as each other, but there's a lot of discrepancy from month to month.
Mhm.
And now we got this kind of jaws opening again. We'll see how it shuts, whether ADP spikes next week or next month and brings it up, or BLS catches down.
Yeah. And
The
sorry to interrupt, but we can say here when they have diverged in this data set, it's been almost always the non-farms that have caught down to the ADP versus the other way around.
Fair, fair. But again, this is only a few years of data.
Yep.
But yes, looking at that graph, absolutely. Uh, the next graph is interesting because now I'm just using BLS data. Now I'm saying, let's take a look at the business survey and the household survey, and what are they telling us? So the uh, the green, are we going to call that teal?
Sure.
Um,
Just call it teal. Keep it
my
consistent.
wife would be very ashamed with me for not knowing that color, but you can see that over the last 6 months, it's picked up 1.7 million jobs. That's the survey that makes the headlines. That's when you open up the newspaper tomorrow morning, that's the number that they're going to show. At the same time, the household survey, where they're calling people, shows that we've only added 640,000 jobs over 6 months. So the discrepancy is that purple line, which shows that there's 100 million, I'm sorry, million person difference. So again, which one's correct? And there's no right answer. These are both surveys. Um, but there's again another decent discrepancy between the headline BLS number and some of their own data. So then you could say, okay, well, let's look into the data. Where's their weakness? And I stole this zero hedge tweet. I think this is very important. Service sector jobs. Service sector jobs account for just a hair under 80% of employment in the US. So what we really want to know is what's going on in the service sector, right? Just like the ISM surveys.
Mhm.
It's funny, the manufacturing survey makes the headlines, but it's the service sector that's 75% of the economy. Um, Same here too, though. You could see that as Zero Hedge writes, it's the largest decline in the service sector since March of 2020. 66,000 jobs were lost in the service sector. Now, to be fair, some of those were education, and education tends to be volatile in June, tends to be volatile in August, September. Teachers are coming off, teachers are coming on. But nonetheless, if you strip it out, there's still a loss of jobs in financial activities, professional services, and some of that education health is healthcare. It's not necessarily education. So it's notable that the large part of the economy is starting to see weakness in hiring.
And
Um,
I think that matches most people's um, sort of personal experience, either whether it's companies they work at or what they're hearing from their friends and family or what they're reading in the papers about layoffs and hiring freezes and things like that.
mhm.
So, I know this is more sort of anecdotal, but that just sort of feels more accurate, I think, to more people, is that the economy, the jobs market is cooling, not in crisis, but
Yes.
cooling. Yeah.
Cooling's a perfect word for that. And here, again, this is the ISM sector survey, and you can see it's below 50. So there's more people saying that they're shedding, more service sector management executives saying that they're shedding jobs versus hiring. 50 is that if you're above 50, your expansion, below 50 is contraction.
Hmm.
You can see if you kind of go back in time that there's really only three periods where it was below 50 for meaningful periods, and those are the last three recessions: COVID, the financial crisis, and in 2000, 2002. Uh, we've been flirting with it on and off for the last year or so, year and a half. So again, the service sector is not strong, and the trend going from 2022 has been continually lower. And lastly, this is from the BLS data. So I'm not trying to show just all other data show that the BLS is wrong. We showed the household survey. This is their diffusion index. How many industries are gaining jobs versus how many are losing jobs? It doesn't talk about the magnitude, just the number of industries. And it's below 50, meaning that there's more industries that are shedding jobs than industries that are net hiring jobs. And here too, you can see that the only times it's really below that 50 marker, the orange line, is during recessions. So the data is that's why I'm saying there's a weakening in the economy. We just showed it from the employment point of view, but you see it in many other data sets as well. Again, it's chilling. It's not recession. It's not panic, but there is a weakness that is occurring.
So I think the challenge here, I'm just going to channel the average viewer here, Michael, is okay. You've just sort of explained to me why the economy is showing signs that it's slowing down, and we just went through a bunch of this data where you said yeah, it seems like the labor market's cooling, and yet we get this big beat number today, which stands in stark contrast to the ADP numbers we got just a couple days ago, right? And the market is on fire. So, to the person that's just saying, I'm trying to understand, like, if we're seeing signs of slowdown, why is everybody so enthusiastic?
Why does everyone go to Vegas? Right? Everyone goes to Vegas because they can make money in their own heads. And it's just these animal spirits. First of all, I think you have to disassociate what happens on any one day
Sure.
with the employment number or anything else. And especially today, the market is very illiquid. The volume is extremely low. It's not hard to push markets in this kind of environment. So you get good news. Had this happened next Wednesday, the employment number market may
Mhm.
not have gone anywhere.
Yeah.
But it happened on a very illiquid day, and whoever decided to push the market higher pushed it higher, and there was no one really to fight it. So, but yes, the market's been rallying. It's not believing that the economy is slowing. And even if it does think the economy is slowing, it certainly isn't going to affect earnings. Oh, and even if it affects earnings, so what? Our price to earnings will just have to increase. We'll just have higher valuations because everyone wants to own stocks because that's what they do. They go higher. So, it's in the short run, sentiment is great, right? We can't go past that. Sentiment is what's driving the market. Narrative is what's driving the market. And we're stuck between the very short-term sentiment and reality. And we don't know what reality is, but we do know the economy is slowing. And that's what, as portfolio managers, we have to constantly grapple with. Is the sentiment and the narrative properly reflecting the true macro foundation? And even if it's not, sometimes we have to go with the sentiment and narrative to some degree, knowing full well that it could be wrong. But, for fear of getting behind
Right.
and
It's
knowing that this
trading the market
market,
you have. Yeah.
that's all you have. We're here and now. It's easy to look ahead and be fearful or be opportunistic or optimistic. But what we have today is what we have. And there's no doubt that sentiment is bullish. There's also no doubt that we're very slightly overbought here. But, again, I'm talking about a consolidation, a 1 to 2 week respite or slight decline. But I'm not telling you that this sentiment is done, right? We could easily go higher in July, like we tends to be the seasonality in July.
Right.
And, we'll see where we get in the fall, which is not really as good a seasonality as July.
Okay. And that's sort of why I'm poking at this, which is, look, I think there's a lot of reasons to look at both the BLS data, which, you, Lance, and I have been doing for years, saying a lot of this is hard to believe, but whatever, that's just been the way it's been. But also just the market and say, look, there just doesn't seem to be a lot of fundamental rationale powering this breakout higher, but it's happening, right? So yes, we can come up with a lot of reasons why maybe this breakout needs to correct, at some point, or at least go sideways for some prolonged period of time to let things catch up. And I guess being like totally transparent, one man's opinion, I think that's probably more of what should happen. But there's a lot of other reasons for why this thing could continue to go even higher. One, the AI trade is on fire, not for imaginary reasons, but because these companies are making phenomenal profits on that. And that could continue to accelerate from here and push things higher, right? So you have that alone. But you talked about
And they're
sentiment.
making,
Good.
more importantly, they're making phenomenal investments, capital expenditures, and that flows through the whole economy. So it's not just that they're profiting, they are spending a ton of money and throwing it into the economy. So it's both. Go ahead.
Okay, great.
Sorry.
Yeah, and that is having a halo effect on anything that touches AI, and probably energy, like nuclear is a great example of that, right? Um, so you've got that, but then you mentioned sentiment. So yeah, the markets are definitely back in greed mode versus fear. But consumer sentiment, and I even think business leader sentiment, has still been pretty low. I just, about a month ago, interviewed Joanne Shu. She's the director of the University of Michigan Consumer Sentiment Surveys. And, she was saying, look, sentiment's pretty darn low. And it's, there's a lot of concerns about how low it is. I haven't talked to her in a month. Maybe those have improved a little bit, but I think they could probably improve a lot more. And so you could get a rebound in confidence, which would more or less add additional fuel to the fire of this run up. Correct, Michael?
Right, and to the economy. Right. One of the reasons the economy's been weaker is because consumers have been spending less, they've been saving more. If they get, if they have a better outlook on the economy, then they may spend more. Hey, let's go out to dinner tonight instead of making it at home. I feel good about my job now. I didn't feel good about it 3 months ago. I feel great about it now. In fact, I may get a raise. So we can start looking at that car we wanted to buy. So sentiment is an incredibly important part of the economy. Given that personal consumption is 2/3 of the economy, how do we feel? Do we want to buy? Do we want to spend money, or do we want to save and protect? And so, like you said, sentiment has been low, and it's not, a lot of people mock the University of Michigan because it has its political issues, right? That the Democrats they surveyed think inflation's 9%, and Republicans think it's 0%.
Right.
And the truth lies somewhere in the middle, so everyone's kind of wrong. So, to some degree, you have to question everything, all of their surveys. But other surveys are telling us something similar, that sentiment is generally poor among consumers and businesses. So it could get weaker, it can get stronger. But you're right, that can be fuel for the market or it could be fuel for a recession if sentiment continues to deteriorate.
Deteriorate, yeah. And I'm just playing the upside right now for the person who is looking at this and sort of saying like, I just don't believe it, right? And I'm just trying to say, right or wrong, there are potentialities where this thing could continue going, substantially higher, even if you don't think it's fundamentally supported. Another potential factor is you mentioned the July 9th deadline. Um, President Trump just released the other day, we're striking a deal with Vietnam. Obviously, we've been in conversations with China, which is the big dog in this fight anyways. We may start seeing wins tick off on these trade deals, which both A, reduces uncertainty, but B, people might be looking at this stuff saying like, hey, that's a better deal than what we had. Like, I need to price that in, right? The big beautiful bill is potentially going to pass and within days, right? If that does, that takes away a lot of uncertainty. And even though people are complaining that there's a lot of spending still in there, that's stimulative to the economy, right? So, I mean, uh, just the fact that you don't understand why the rally's happening, maybe the fact that you don't like that it's happening, doesn't mean that it can't continue. So who knows what's going to happen from here? I'm just trying to say, while I'm trying to poke all these holes in it, I also want to say there's a lot of reasons why this thing could just be more bulletproof than the average skeptic would think.
And here's another one. The Fed could start aggressively cutting rates in May of 2026. That's when Powell's term ends and Trump makes his new appointment. So it seems likely that whoever he picks is going to be a very dovish Fed president, Fed chairman. So regardless of what Powell does for the next 10 months or so, you have someone that will be in that seat that will be much more dovish. And if you're starting to think about the economy over the next 3 years, that could have a pretty powerful impact. And it's not that far away.
Yeah, I've got to imagine that that's already pretty much priced in, even though we don't know who it's going to be. I'm pretty sure the market's got a high degree of confidence. It's going to be somebody who's willing to press the cut button a lot more than
Oh,
Powell.
Adam, everything's priced in. That's the tricky part with all this. The market is priced for there's nothing you and I know that the market doesn't know. And that's what as investors we have to get our hands around. That you don't know, unless you have inside information, you don't know anything the market doesn't know. The market is always priced for the latest knowledge. And we have to accept that whether you think it's priced correctly for that knowledge is kind of really the real question. Is it priced correctly or incorrectly? And when it's priced incorrectly, that's when there's potential opportunity. When it's priced correctly, the price is the price, and it's a fair price. It's fair value.
All right, yeah, all right. So I'm going to move on from this in just one second, but I wanted to now re-ask my earlier question, just given your point there. So the market broke out, you know, 10 days ago, whenever it was. What is it pricing in there that it wasn't pricing in before, do you think?
I think the rally can start to continue from pre-2025 because we got over some of these hurdles. Our relationship with China on the trade side is much better than anyone feared. The tariffs are not going to be nearly as impactful as some people feared on both trade relations and the inflation side. So, and AI just continues to just put out stunning data. The amount, again, it's not even the profits, it's the amount of money that these companies like Meta, Amazon, Google are spending on infrastructure that's affecting so many different industries. And then those industries affect broader
Right.
industries.
Sorry to interrupt, but so think of it like a private form of stimulus, like we saw during COVID to a certain extent. It's just a ton of
Exactly.
money coming out of these private coffers, and hopefully, in this case, for productive use, right? It's not just a one-off, it's something that's going to create ongoing future value.
Right. And it's industries you're not thinking about. Natural gas pipelines. So I just wrote a two-part article called Behind the Meter Solutions. And it's fascinating. The current power grid cannot handle these data centers.
Right.
They're just springing up so fast, and it's hard for these electrical grids to grow as fast as the data centers. So what they've been doing is this, it's called behind the meter solutions, where they basically tap into a natural gas pipeline, create their own power plant, and fuel the data center. So who does that help? It helps the natural gas pipeline companies. It helps the companies that make stuff for these power generators. So it's no different than using a generator for your house that's plugged into your natural gas line. It's doing the same exact thing, but on a much more massive scale. So, there's companies that are making the turbines and the control units and the lateral pipes that connect the main pipeline to the power plant. So there's a lot more industry that's involved than just those big AI companies whose names we hear about constantly. And then of course, all the companies that benefit from AI, which is in theory everyone. In some
Right.
way, everyone should benefit from AI. Some more, some less, but it should at the end of the day help the bottom line. And you also have a robotics uh, revolution here. We wrote a few days ago, Amazon now has 1 million robots. They only have roughly 1.5 million employees. There are going to be more robots than employees at Amazon soon.
That's pretty amazing. And we've got Tesla poised, we'll see what happens, but poised to release Optimus at the end of this year, right? Which is its humanoid robot, right? Um,
And the
and
robo taxis.
robo taxis there's okay, there's a discussion I want to have here with you. Let me just pull up this one chart because it's relevant to what you were talking about. And I'm not sure most people still get this, which is to win the AI race, you have to have abundant and affordable energy, right? And the U.S. electrical grid is has a lot of problems. It's kind of sclerotic. It needs to be rebuilt to power not just our general energy needs of tomorrow, but certainly power our dominance in AI if we want to win in AI. And here you can see here, measured in terawatt hours, the electricity generation production capability of the major world powers. You can see here that the US and the EU have not really done much in the past decades. You can see here that India is coming on strong, but China just leaves everybody behind. I think I read somewhere, based on this math, it's something like they're adding basically like a US a whole United States worth of electrical production capability every 18 months in China. So I think we've gotten the memo and we've said, look, if we want to win in AI, we got to beat China here on electricity production. And that's why you're seeing, all this focus from the new administration going into deregulation and reviving nuclear and all that stuff, right? But we clearly have a lot of uh, road we got to catch up to China with here. So there's just so much spending that's going to go into AI and electrical capacity here in the US that it's just, what do you think? I mean, that's just trillions and I think I've heard like 6 trillion or so that it's going to require over the coming years. I mean, it's just a
Yeah,
massive wave.
it's massive. And that graph is, first of all, it's a great graph, but it can be a little misleading. China is still electrifying people. There's plenty of people in that country that don't have electricity. Same with India. So some of that growth is just for light bulbs and ovens and basic necessities of life. It's not for
Right.
industry per se.
But what a force multiplier, right? You take
Oh,
your population that was basically living in, dark huts, and all of a
right.
sudden they can do more to be economically productive.
Right. But just as a comparison, their population is about 4 times ours. Their electricity generation is a little more than double ours. So per person, we still have a lot more electricity generation. Um, and the service sector, this is a presumption, I presume uses a lot less electricity than manufacturing. So given that they're more of a manufacturer, we're more service sector, that plays into it too. But the data needs from these AI and cloud data centers is incomprehensible. And I really think we need a sea change in the way that we look at how we're gonna electrify this country. We have to, like it or not, I think we have to accept natural gas as that bridge.
It's the bridge fuel, absolutely, before
It's the
nuclear. Yeah.
bridge fuel. I'm not saying that solar or wind or nuclear can't be that power source in the 2030s. If we can figure out a way to make solar panels a lot more efficient, that may be the answer. There's hydrogen. There's all kinds of things that are being worked on, and now we have AI to help us invent that stuff.
Right.
So what may have taken 10 years to figure out may take 2 years to figure out, or 6 months to figure out. Nuclear is another great one, but it takes 6 to 10 years to build a nuclear facility. So we as a country have to accept that natural gas is the answer to fueling the electrical needs of this country. It is in extreme abundance. If you look at a graph of natural gas, it's gone nowhere despite the usage going up quite a bit. It is, it's basically, some of it is burned off with the shale. When they're pulling the shale oil out,
Right. The
the
flaring.
natural gas is a byproduct that in some cases is just being burned off. It's just too cheap. It doesn't make economic sense to try to get it somewhere where they can sell it. It's more expensive to do that. It's cheaper to burn it than to do that. So, I think as a nation, we have to accept that natural gas is that solution. And doesn't mean we can't focus on greener energy types, on more efficient energy types. But if we're going to win this AI race, we need to get those power grids and we need solutions that work around the power grids, like this behind the meter solution. And I'm sure there's 10 others that I'm unaware of that also do that.
Okay, so you're taking it where I wanted to take this, which is okay, if this is a kind of a mega trend going forward, then presumably that creates investment opportunity. Um, Obviously you can invest in AI by owning these big AI companies. Now you can argue whether they're fairly valued in the near term or not. But obviously there's other ways to play this, and energy is probably going to be a big one. You've just done this report. Like where are you more excited to put capital right now to take advantage of this mega trend?
So we've been on this on the data center growth for well over a year. We own GE Verona, for instance. They make the turbines in these behind the meter solutions. The stock has done really well. NVIDIA has done really well. Uh, we own two natural gas pipeline companies. Um, we own ServiceNow, who helps make data centers. We recently bought a piece of BlackRock Financial, who is helping finance. So, this goes back I actually just read a great book called Cattle Kingdom. The ones that it appeared the easy money was the cowboys that were bringing the horses from Texas all the way up to like places like Chicago, where they would either put them on a train or butcher them. That was kind of the end point. And at first, having these free range cattle farms and getting them to market, it was a boom. It was like gold in the mid 1800s. This was like I want to say it was after the Civil War, 1860s, 70s. And it turns out that the ones that made the lasting money were all the periphery businesses, the livestock stock, the refrigeration companies, all the
Hmm.
companies around it. The Cowboys went bust. A lot of money was lost one bad winter, and a lot of homesteaders and other issues. Just it was a bubble. It was basically a bubble that very few people know about, but it was a cattle bubble.
Cattle
Just
bubble.
like the people that made, Levi Strauss, the guys that made the shovels, they're the ones that made the money in the California gold boom.
Right.
There were certainly some guys that found a lot of gold and made great
Right.
money,
But a
but the
vast
ones,
majority who didn't and went bust. Yeah.
right. So we're looking at both. basically all aspects of it, but not just the Googles and the Metas and the Amazons, but we're looking at the whole periphery and trying to figure out who can really benefit. And we've been on it for well over maybe 2 years now, and we're continuing to focus there.
Okay, that's awesome. And I appreciate you sharing those specific positions that you're taking. It gives people
And there
some.
are, if you look in the part two of that behind the meter solution articles, I do actually go through a few companies, some of which we own, some of which we don't, that are poised to benefit from just behind the meter solutions, not necessarily other things. All these companies are pretty big. Like Caterpillar's one. Caterpillar is a very diversified company. The behind the meter solutions may not mean that much to them. Other companies like GE Vernova, it's a big part of the business. So, but it gives you an idea of some of the companies involved. And I mentioned a couple ETFs as well.
All right, great. So folks, you can go read Michael's articles that he's referencing there on Behind the Meter at realinvestmentadvice.com. Michael, I also was talking sort of on this topic with Lance about 2 weeks ago, and we asked the audience, hey, would you like us to do a special event on sort of energy AI investing, where you and Lance get on, talk about this, and then we take some live questions from the audience. Lance signed you up for that, just in case he hasn't actually told you directly.
Shocking.
Yeah, shocking. And he'd referenced this, that you were at that time working on this pair of articles. So anyways, the interest was very high. So when after he gets back from his trip, are you game for actually hopping on maybe, one evening with us to do a live event for this audience?
Yeah, absolutely. Whenever you want.
All right, thank you
It's
for that.
really fascinating. One of the things is, so I'm outside of DC. I'm in the Maryland suburbs, out by Dulles Airport, which is in Virginia. It's about 20 miles west of DC. That is where there's a huge amount of data centers going up. And I was just there a couple of months ago, driving from like West Virginia through the Dulles area to get home. It is shocking how, first of all, how big these data centers are and how many there are. These are big buildings. And this is just one. Northern Virginia happens to have the most data centers in America, but Texas has a lot. California has a lot. They're scattered all over the place. And if you kind of get out to the exurbs of a lot of these cities, and pay attention, you'll notice these things all over the place. And it helps give you a little scope for the investment that's being, again, it's also brick, it's refrigeration, it's the construction workers. It's not just the highly technical NVIDIA chips that's going to profit. There are so many industries. It's the restaurant that
I was gonna say,
services all
yeah.
those workers. And, I mean, it's really helping out communities.
Yeah, like I said, I think it's a good analogy in terms of the scale is not that dissimilar from the massive stimulus that we saw during COVID.
Mhm.
Um, but
But it's
it's
productive.
productive and it has an economic multiplier effect, unlike what we saw before, right?
Correct. That which had a negative multiplier effect. This is positive.
Right, right.
Growth begets growth.
I've actually had an interesting seat to this because there's a fellow who lives in my town, who's an acquaintance, and he had this company that he'd been running, yeah, out of his house mostly, um, for years, decades. And some little technology company, they manufacture some little optical switch or something like that, and has turned out to be just a critical component for data centers. So, his ship has come in gargantuan fashion over recent years, and his company has just barely been able to. I mean, it's grown like bananas, but it's been barely able to keep up with demand, and the demand is just it's relentless. It's unrelenting, really. So I've seen this guy go from, I would say a moderately successful, independent business guy to like a tycoon.
Yeah,
Yeah, and again, it's so far shows no sign of abating, and congrats to him. I've been really happy to see this happen to him, but it's been pretty amazing.
right. Right. I mean, the lesson is look beyond those big companies that are very obviously into AI, and you'll see its influence on a lot more moderate-sized companies and just very small companies that are not publicly traded.
Yeah. So, okay. So again, for those who are, well, I want to get to an interesting idea I have around Tesla, but before I get there, so for the person who is looking at the big macro picture, Michael, which a lot of the guests that I bring on this channel do, and say, all right, I think valuations are really stretched. I think the economy is slowing. Maybe they've got more concerns about a recession arriving than just slow growth going forward. Um, uh, you can make a compelling argument that, hey, we're nearing some sort of corrective event that we saw in 2022, or maybe something even bigger, like we saw in previous recessions. Um, I just want to hold that in contrast to what we're talking about here, which is, you know, an argument for a lot of growth ahead and probably a pretty good market ahead.
We're talking about a 5, 10, 15-year macro picture. The market will inevitably get ahead of itself. It will inevitably get behind itself on projecting that how that impacts the economy. And that's where you get these ebbs and flows in the markets, where you get like a 2022 where it does correct because it just got too far ahead of itself. It thought it was going to be too much too quick, and vice versa. Then the market gets beat up and it goes too far down. We saw a little bit of that with the tariffs. It turns out the tariffs weren't nearly as uh, detrimental as they look like the day he wheeled out, Trump had that poster where he's taxing everyone, you know, to the moon. So, and it's in those ebbs and flows that there's either money to be made or money to be saved. So again, but we're talking about a macro, longer term trend. And it doesn't mean you can't have a recession. It doesn't mean the market can't go up 30% this year and down 40% next year. It doesn't exclude any of that. But what it does mean is that I think the country's longer term economic growth trajectory is higher today than we would have said 3 years ago
Okay.
because of AI.
Okay. So on that, for a year and a half now, at least, you and Lance have had a long bond um, position that has, I believe, um, kind of at its core, hey, the economy is going to continue to slow. As a result, inflation is going to continue coming down. And therefore, bond yields, which are a function of inflation expectations, are going to come down. How do you square that with, hey, I think all this is going to be creating greater economic growth going forward?
So growth impacts inflation, but it's also a function of supply and demand. And we're going to have a more productive economy, but that doesn't mean that inflation is going to be necessarily running hot. Inflation has typically been at 2%, and the economy is still slated to grow 1.6, 1.7%. So even if we are upticking that rate a little bit, inflation is still probably going to grow in the low twos, and the Fed will do what it can to keep it around two. Bond yields are in the fours. That's 2% higher on a real perspective than they've been in a very long time. So our point of contention is not necessarily that the economy is just going to be weaker for a prolonged period and we're going to go back to the good old days, just that interest rates are still too high. And I would make the argument that higher interest rates are causing inflation to actually be higher, the opposite of what Powell's saying. Because
Mhm.
what's going on is the market is embedding inflation expectations, higher inflation expectations in a perverse way. So the problem we have as bond investors is that inflation has been coming down ever since it peaked. We're now in the, what are we, 2.3%?
Yeah, we're in the twos.
Right. And bond yields
Good
they've
twos.
come down a little bit recently, but they haven't come down that much because it's dealing with one bad narrative after another. Deficits are going to bankrupt this country. Tariffs are going to create massive inflation. So, this is very similar to our discussion of why the market's going up. It's the exuberance. You got the opposite going on in the bond market. Doesn't matter what happens with economic data or with inflation data. Those bond bears are out there saying, oh, the deficit's going to crush this country. Oh, inflation. And they're a forceful uh, group to be reckoned with right now in the bond yield. But over the shorter term, we still think bond yields come down. We're not buying these bonds for 20 years, even if we own 20-year bonds. We could easily sell them today. We could sell them in 6 months. We could sell them in a year when we think rates get down to that target that we think they're going to get down to.
Okay, but right now you are still in that trade, right?
Yeah, we haven't changed our position. And I do think the Fed is going to cut more this year than the market thinks. I do think I think when the Fed can get their hands around this tariff inflation and they realize that there may be a little bump, but it's not the impact that I think they were thinking a few months ago
Yeah.
or 6 months ago, that'll give them the green light. And look, the Fed's not dumb. I know they look at the BLS data and they look at all this other data. They know that the labor market is really slowing. And it was Michelle Bauman and I'm drawing a blank, Christopher Waller, both came out about a week ago and said, now is the time to start cutting rates before we're in an employment kind of crisis mode and
Yeah.
have to cut. So you're starting to see a little leakage in that
Yeah.
that consensus hawkish tone to a more dovish opinion. The other thing, this is what really bothers me with these tariffs. What if this afternoon Congress and the president said, we're doing a 10% sales tax on everything? Prices would go up 10%, right? Well, what can the Fed do about that? It's a
So
one-time increase.
this is exactly what I was going to ask you. So I asked Lance this last week, his exact thing, which is a tariff, if it does get enacted, should be a one-time price shock, right?
Hmm.
Prices re-rate, then presumably, tariff stays where it is. So inflation very quickly becomes zero, right? Again. Um, what can the Fed do about a one-time price shock? Nothing. There's no sustained inflationary pressure after that, right? So why is the Fed even waiting to do something about this? Because it doesn't really have the tool to fight it.
The funny part is, price is all about supply and demand. That's one of the known truths of economics,
Hmm.
supply and demand. In 2020, 2021, 2022, there was massive demand and reduced supply. That was obvious. The Fed didn't understand that. That was a driver of prices. They
Yep.
seem to very much understand that tariffs, though, which it does affect supply demand, but it's not nearly the same magnitude or impact. That's the one they have concern over. So it's kind of funny how they're gravitating to something they have no control, very little control over, and they couldn't even see this monster that was brewing because of the gross imbalances because of COVID and
Right.
the
Well,
reaction to COVID.
so the Fed is often criticized as being too late in policy, right? Always driving in the rearview mirror, right? And then they're often criticized for being wrong. Um, are they too late and wrong both at this time, in your opinion?
I think they're late. And I think I've said this on your show a year ago. Rates are too high. They don't need to be this high, and I think they could be feeding inflation expectations as well. So I think they are actually possibly higher rates are actually hurting their goal of getting inflation down to
Inflation.
its target. Um, I think right now the Fed's not being punished for being too late, but the economy can change somewhat rapidly. And if they find themselves behind the eight ball, they could look pretty bad like they did with inflation.
Okay. All right. Well, I'm looking at the time here. I want to have a segue topic here, and then we'll get into the rant. So uh, I was not caught up in the initial, rightly or wrongly, was not caught up in the initial exuberance around Tesla, years ago when the Tesla bros were saying, man, it's way more than a car company. You don't get it, right? And back then I was thinking, maybe, but like it's in the car business right now. And until I start seeing revenues from some of these other things, like I'm not gonna drink the Kool-Aid too much, right? And rightly or wrongly, that's how I felt. Now with AI really beginning to manifest, and Tesla just launching the full self-driving of its cars, and then the robo taxis, and then the other day, I think they had the first fully autonomous uh, supply chain with a car, meaning it got built in the factory, rolled off the factory floor, and then drove to the home of the person who bought it. All without a human touch, right?
Right.
So I'm looking at what Elon is doing, and he's investing in Grok, right, through XAI, right? And so to me, that's just one of the big massive AI players in the big race that's going on. Who can make the smartest AI? Um, what I'm increasingly seeing Tesla as is with full self-driving, with robotaxis, now with Optimus coming out, is the company that when AI needs to control something in the real world, they're creating the vehicle for it. Whether that's a car, whether that's a humanoid robot, whether eventually it's something that looks nothing like either, but it just performs a very specialized task that AI, needs to control. And just like creating a new AI large language model, only a few companies can do that, right? It just takes a ton of resources, a ton of
Right.
capital, right? So the fact that someone's going to invent one in their garage is really low, or that a small company is going to be a threat. And I think in the space of creating, machines at scale that AI can control is also a very narrow world. There aren't that many companies that can do it. And Tesla kind of has a huge start on almost everybody because it's got
Right.
all parts of the stack. And look, I'm no AI expert on this, but I was listening to the AI podcast, sorry, the All In podcast, which is the most popular podcast in the world, and it's got these four super successful tech executives that do it. And they were talking with each other a few weeks ago about, okay, well, who do you think is going to win the AI race? And they pretty much all had Tesla near the top of their dance card. And they talked about sort of this exact thing that I'm talking about, which is the melding of the software and the hardware. So I'm just curious, do you have thoughts about this? Is Tesla maybe as, crazy as the market value for that company is it potentially underpriced here, given that market opportunity of kind of the world of physical things that AI controls or will control?
It certainly could be. It's really very difficult for me to value that company. And part of it is what will be in Tesla and what won't be. Grok AI is not Tesla. Starlink is not Tesla.
Hmm.
So if I could buy stock in Elon Musk Incorporated and have access to everything that goes
Right.
on in his head,
SpaceX and all the other cool stuff. Yeah,
right, I
exactly.
just want his brain. I want shares in his brain. That's what I would love to buy. Um, the disappointing thing with Tesla is they had a monopoly in electric cars, and they've kind of let it go. They've really lost market share. There's a million electric cars now all over the place. Every company has electric cars. China's eating their lunch
Right.
in electric cars. Um, this robo taxi was supposed to be the big thing. Waymo seems to have the lead on it, and my guess is there's going to be three other companies that will pretty quickly get into that or are in it, and Tesla is not really getting that first move advantage that people thought they would have 5 years ago.
Let me just push back on that for a second. So first off, if they were just a car company, I wouldn't be thinking like this at all, right? I'd agree with you. Um, but so full self-driving, right? Fully autonomous, robotaxi. Um, so all of a sudden you start asking questions like, well, okay, so like, why would somebody take an Uber in the future? Like, how is Uber going to compete with this? Or how is any kind of delivery service going to compete with it? DoorDash,
Mhm.
Instacart, Postmates, all that stuff, right? And you're kind of thinking like, okay, well then maybe those companies would have to build their own fleets of, autonomous cars, right? Maybe they just buy
Right.
a crap ton of Teslas, and that's what Uber uses, right? But then why wouldn't Tesla just say, well, why? Why don't we just offer that ourselves? We've got the cars, Why don't we just offer the Tesla? And that, of course, that's what robotaxi apparently will start to be. But all of a sudden there's multi-billion, multi-hundred billion-dollar markets that they're potentially getting into now because of this autonomous driving. And that's just in the car space. And then, of course, you layer anything else that AI does in the world, controls in the world on top of that.
Mhm.
It could be really big. So I agree with you. If you're just looking at electric cars, yeah, there's
But
small
no,
potatoes here.
right. I see it as software, right? If Tesla can really become a software company, they sell the autonomous driving software. So you buy a GM, you buy a Ford, you buy a Porsche, it has the Tesla software in it, right? That's where then all of a sudden every car that's sold, they're getting a subscription from it, right? It's more of a subscription business than a one sale basis. And same with all with all this other stuff, with Postmates and with Uber and all that stuff. If you can basically turn Tesla into a software company, I think that's the greatest outlook, where they're getting a chunk of everything that's going on in all those things you mentioned and many others.
Yeah, so I don't want to be selling sunshine here, and I'm not necessarily telling people to go out and buy Tesla here. I just maybe I'm late to the game, but it is dawning me how big this addressable market could be, right? What you just mentioned is those are big new markets for Tesla. And
Mhm.
again, just in the car transportation industry, right? Like I'm thinking even more, as I'm sure you've gotten by now, but
Yeah.
like Optimus, which we haven't really talked that much about yet. And who knows what's going to happen with it? Maybe it's the next Segway, right? Maybe it's just a big dud, right? But
Right.
um, Musk certainly thinks that every home, once it becomes affordable, is going to want one, and it might actually be the dominant way in which you don't just have a robot butler, but as Elon likes to say, it's like a robot buddy, meaning like it might supplant your phone, right? It's got a face that's more or less a screen. You could just kind of like Alexa, just ask the robot questions that you want answers to, or I want to watch a movie right now. And so he starts showing you a movie on his face, or, robot call so and so, right? And you're talking to the robot like I'm talking to you. Um, so transformative that way. But then, of course, then there's, the commercial world where all these jobs where you need a human, but a robot that's affordable provides a whole ton more advantages. It gets the job done maybe just as good, if not better, and it doesn't take breaks, and it doesn't go to sleep, and it doesn't go on vacation, and it doesn't show up late, and it doesn't have HR issues, right? It
Right.
doesn't get sick. Um, it potentially,
Until AI gets smart enough, then it'll go on vacation.
that or kill all of us, of
Right.
course, that's
One
where
of
we
the
get
two.
to when we play this out far enough. But my point is there is like there is just a potential massive, massive market there. So I don't know how to value it. I don't know, let's let them launch Optimus and sort of see how it goes. But if that becomes kind of an iPhone moment for the robotic, world, and Tesla's the one that's, positioned there for that. And again, too, it doesn't have to just be humanoid robots. I mean, they
Right.
can build all sorts of things that industry needs. So it's going to be interesting. I think I've planted the idea here, so we'll revisit it as time goes on. Let me now segue to the rant here. So I just recorded just a highly enjoyable and fascinating conversation um, with Greg Lukianoff, and he is one of the co-authors of the book The Coddling of the American Mind. Um, so he's been at the forefront of really kind of helping society start to take a hard look in the mirror and say, hey, look, we're really seeing some degradation from generation to generation in terms of just people's resilience in the world, right? So, we've talked a lot, and Lance has certainly ranted even more than I have about younger generations, and everybody's a special snowflake, and they need their safe spaces, and if they don't like something, they demand it gets canceled, and, all that stuff, right? And he goes through just the price you pay for comfort, really is what he
Right.
said, is this is the price of comfort. We have You ask anybody, you can live at any point in time in human history, and most people would pick today because it is the most comfortable lifestyle, right? Um, and as a result of that, um, you get used to comfort, and your ability to deal with adversity gets less and less, right? And then you end up having real issues with that, where you have as we have increasingly had with the recent generations, failures to launch, right? Kids that don't want to or aren't prepared to go out into the world. And we also have some real issues coming ahead of us, potentially lots of job loss from AI and things like that. But we have this increasing disconnect uh, preparing people for the realities of the world, right? And I wonder, in the sunshine that we get sold by the AI salesmen, it's don't worry, AI is going to do everything for you, right? You're not going to have to work. The robots are going to do the work. Whether it's UBI or whatever, you're just going to be able to have time to be your best self and invest in the things that matter most to you. And to me, I almost think that's the worst thing that could happen to humanity, because we are evolutionarily lazy, right? We've been told to conserve calories whenever we can. And when we don't have to do something hard, we don't want to do it. And we have given pretty much everybody on the planet the world's the sum of the world's information for free. I mean, you can learn just about anything at practically zero cost through a device like this. And what do? We watch, cat videos and pornography, right? And so there's a real toxicity to removing people's purpose in life, right? And almost like the bones in your skeleton, if you're not putting pressure on them, if you're not stressing them, they actually weaken. So I do think that there's a lot of really big risks of AI that we are not, I think, thinking through as we rush headlong into it. And let's even forget Skynet and the fact that they probably all will kill us, someday. But just the fact that we're probably going to displace a crap ton of people from jobs in the next coming years, and not that far away. I mean, it's already beginning to happen. Um, but we're going to displace them way faster than we find ways to repurpose them. So there's going to be an underemployment and probably big unemployment crisis in the near term, I personally think. But even if the quote unquote benefits manifest really quickly, right? That like, oh, you're going to get your stipends and you're not going to have to work, and the robots are going to not only do your job, but they're going to deliver, your government sponsored groceries so that you can, stay at home and live in Ready Player One or whatever you want to do. I feel like that's just going to be just highly corrosive to our cultural strength. I mean, I think we're just going to, there's a real danger of us, I think, just sort of wasting away as a culture in that type of future. What do you think?
That's my concern too. It takes away our incentive. Like one of the things that makes capitalism so powerful is the is greed. It's the incentive to have more. And under a communist society, and lesser so socialist, that incentive is stripped away. And what you're kind of describing with AI, UBI, how are we going to pay ourselves if one computer, one, AI engine can do the work of 10 million people? How are those people going to make money? And if the answer is, well, the company or government will just write them a check, I fear that people are going to lose that incentive, that the greed, the ability to innovate and to create new things. And it's very scary. But we don't know how this is going to play out. And there's benefits, there's cons, and the scary part is it's happening so fast. And you know what? It's in my opinion, it kind of leads to more of a socialist system out of necessity. You can't have that many unemployed people and not pay them, or you're going to have riots. So You know, I think 20 years from now, we're talking about a much different type of economy. And I'm not saying it will be socialist, but I think we need to, these are some issues we need to start thinking about now and plan for it and try to, it's funny, survive and
Yeah.
but
So,
keep us driven and innovative and productive.
Michael, you look at social programs like welfare, right? And I'm sure we can have a debate, but I mean, there's a lot of research out there that shows that it does ultimately create a dependent class,
Right.
right? And for a lot of reasons, because it removes the incentive, right?
Hmm.
So removes the incentive of the recipient, and then their children are getting raised in an environment where, if that torch can be passed to them, well, what's their incentive to go out and work, work hard to learn and
Hmm.
then, work? It's, oh, I already know this lifestyle. Let me just stay with it, right?
Right.
So to your point, there's a real danger here of creating a dependent class on a maybe a much grander scale, which is scary. And to your point too about like, you know, uh, how they're going to be fed and all that type of stuff. The UBI people, in my mind, like I'm giving them the benefit of the doubt. Okay, so they're getting paid enough to afford whatever they feel they need to have, and yet they're still losing their incentive to work and stretch, and they just
Right.
become dependent because of that alone. But really, economically, you give people a whole bunch of money, what happens? Well, the cost of everything goes up and the purchasing power of that money goes away, right? So it's like, I don't even get how the UBI is going to work, right? Because yeah, there'll be 6 months where everybody's happy, and then there's going to be forever after that where people are like, this doesn't buy me jack.
Because they can't be greedy. You know, if you know you're getting the same thing every month, you can't get more. And I think it really creates a lot of problems. I also think not working, not thinking is a huge problem. I saw it, you know, that I saw it with my dad. I know it happens to a lot of retired people. They retire too early
Yep.
and they kind of lose their purpose. Right, what am I going to do? Right, if all of a sudden Lance tells me, "Hey, Mike, here we're going to just write you this check every month. Just go away, and you're going to get this check, and it's a nice number, and I can live happily on it." What am I going to do all day? You know what? I mean, I like to think I'll find something to do other than playing golf or, you know, but it's a lot easier
Watching
said than
basketball.
done. What's that?
Watching basketball, which I know is a
Well, the
passion.
problem is there's no baseball is the only sport now, so now I'm really kind of screwed. No, but people have to think and people have to work, and I really think that's there is a time to retire, but I think that's good for you, and I think it keeps you happier in most cases, whether you know it or not. It may not seem like it, but I think a lot of people would love to quit their jobs and have money, but in 6 months they'd be bored to death.
Yeah. So I talk a lot on
That's
this. I talk a lot on this program because it's a wealth building program, about how, hey, let's have a, eyes wide open recognition that money is important, but it is not an end in and of itself, right? It's a means. And so that begs the question, well, then what is true wealth, right? And the research is really clear on this, which people have heard me say many times this channel. It's quality relationships, it's purpose, and it's health. And Michael, I know that you believe strongly in all three of those. And really, if you look at like the quote unquote blue zones, it's pretty much what people spend their day doing. They
right.
wake up, they have some sort of job, whether it's just gardening, for some of their calories. They interact with the people around them, and their activity is keeping them in good physical health, right? You pull away any one of those three pillars, people really start going downhill pretty fast. And it seems like here at a minimum, we may be pulling the purpose pillar away from a pretty large swath of society.
Right, right. It's concerning and it probably will weigh on our health, but then AI will make us live even longer. So we'll be living out our days in misery,
Yeah,
uh,
if we're all just
till
heads
we're
in blue jars of
150 years
liquid.
old.
Yeah. Yeah, if we're all heads in blue jars of liquid, but we're, it for 200 years, is that really a better way of life, right?
Right, right.
Yeah.
You know, change is always difficult, and who knows how this is going to turn out. It could all be for the better, could all be for the worse. Um, but we just have to consider all the options and how do we fit into it and what can we do to protect ourselves mentally, physically, money wise from what could be coming down the pike sooner than I think most people think.
Yeah, well, and I think that's the key thing from here, which is here's my concern and maybe injecting, some little bit of hope in this, which is there are definitely going to be a bunch of benefits. I personally, right now, given my read on it, think that they are going to uh, they're going to concentrate in the hands of a smaller portion of society, just like wealth has been, right? So AI in many ways will probably only, in my personal opinion, drive this inequality that we've been seeing, wealth and just sort of quality of life otherwise. And so, yeah, that's not very good for society if I'm right there. But I think what we need to do is say, hey, like what can we do to not become collateral damage in this and get more of the benefits than more of the costs? And particularly, what can we as providers for our families do to make sure that our kids have better odds of entering this future? I've been talking a lot with uh, people like you who I interview on this channel who have children, and they are saying, it's getting tough out there. And if you look at the graduation, or sorry, if you look at the employment or unemployment rate of recent college graduates, it's like, I think 5.8% versus the 4.2% general population unemployment.
Right.
If you look at, was it the top MBA schools, it's something like a quarter of their graduates don't have a job lined up by the time they're graduating. So we're already entering kind of a tough market just secularly. But I think AI is going to continue to contribute to this, where there's just not going to be as many jobs there when we come out of this cycle than we've had in past cycle turns. So, you really need to help your kids think through, okay, how do I want to, you probably need to have some relationship with AI as a kid growing up today. Because if you're just ignorant of it, you're going to be totally iced out. It doesn't mean you got to be a programmer, but you got to start asking yourself, like, how can I work with this thing to maximize my ability to advance my ability to contribute value and minimize my ability to be told, we don't need you because AI can do that.
Right, right. And I think, look, I know my kids at least, they all, two of them are working, one's still in college. They all use AI in their jobs or in school uh, to help them to, to help them do their jobs better or to focus on things in school. So they're probably a little more tuned into AI than we are. I think we think about it a lot from the investment perspective.
Mhm.
And look, I use it a little bit, but I think it's just more natural for them. They're much more technology oriented to begin with. So for them, it's probably a bigger shock for me and you than it is for our kids. We didn't
It,
grow up with
it,
the
it,
technology they did.
yeah, I hope you're right, and I'm sure there's real truth in that. My worry is you and I are going to be harder to displace because we have decades of experience that have led to the expertise that we have. So replacing our expertise is a bit harder. Whereas if you're just a new person starting out, um, they might say, look, we're just going to invest in AI. And yeah, maybe if AI is a little bit worse for the first year or two, but it's learning super fast, by year three, we're going to feel like we got our money's worth out of this.
Right. Could be. And
Yeah.
it's going to be a different road, but uh, we'll see where it takes us.
All right. Well, you're making me think at some point too, I should get an AI expert in here to talk about kind of the real world aspects of AI, not the like, okay, here are the big trends and here's where the money's going to be made and all that stuff, but like, this is how it's going to impact society. And if you or your kids don't want to get, basically shut out of the future prosperity that AI is going to unleash, here are strategies that you should use.
That
Folks,
would
I think that'd be
that'd be
interesting.
outstanding.
Yeah, if you're interested in that, folks, let me know in the comment section. If interest is high enough, I'll go try to find whoever that guru might be. And if folks are more knowledgeable about AI than me, which isn't a super high bar, if you're watching and you're someone who's been studying this for a while, if you've got a good expert who you think would be good, let me know their names in the comment section. I'll reach out to those people.
Or
All
you
right,
can just
Michael.
ask AI.
Yeah, I guess I probably could just say hi for that. It's a great point. All right. Well, Michael, look, I can't thank you enough. Folks, please thank Michael again for pitching in, pinch hitting for Lance. Like I say, every time you're on, Michael, maybe we need you to become more on the regular lineup here. Give Lance a little bit of a break, but people always love hearing you, and you did another fantastic job this week.
Great. Thank you. Appreciate it.
All right. Well, folks, again, please hit that like button to thank Michael, and then make sure you subscribe to the channel below. And then very importantly, there's, as Michael said, like it's an uncertain road ahead in the sense that lots of arguments for why this breakout could power a lot higher, and there's a lot of arguments to be made that it should go sideways or correct for a bit. And then, of course, there are the arguments that can be made that this thing's just way too overvalued and much lower prices are ahead. So how do you navigate through all that? Well, it's pretty tricky. If you're, a DIY investor, unless you've got a really strong track record of doing well in periods like this, highly recommend that you, and of course then every other person watching this video, get some help from a good professional financial advisor to put together a portfolio strategy to try to accommodate all these different potential outcomes that we're talking about, and then hopefully actually execute on that for you. If you've got a good financial advisor who's doing that for you, great, stick with them. But if you don't, or you just like a second opinion from one that meets that criteria, maybe even Michael and Lance and their team there at RIA, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill it out. These consultations are totally free. There's no commitment to work with these firms. It's just a free service they offer to help as many people as possible. Michael, my friend, again, it's always great when you come on here. Again, happy 4th of July. I will give you the last word here.
Well, for you, happy 4th of July. For everyone else, I hope you had a great 4th of July, and I look forward to being on here soon.
All right, my friend, we'll do that, and especially maybe quite soon with that artificial intelligence energy investing live webinar that we were talking about.
There you go. Whenever you want.
All right, thanks, buddy. Really appreciate it. And everybody else, thanks so much for watching.